Hello, welcome to Compass Wealth Management's webinar. My name is Robert Amato. I'm the principal here at Compass Wealth Management, and we're going to go over the agenda in just a minute. I just want to make sure from a technical standpoint, everybody can hear me. I don't know if you guys can click that icon, the little hand raise, if you might be able to hear me. Just want to make sure we are getting off to a good start here. And while you are doing that, I want to welcome you guys to the first Compass webinar. And this webinar format, we hope, is going to allow us a little expanded view, folks that are out of town. We're going to keep this today to 30 minutes. And I'm going to start by going through this tax guide that we've put together. Everybody's going to get a copy of that. And then in the back half, for the last 10 minutes or so, we're going to focus on applying this to clients, how we are taking these tax laws and applying them to your specific situations and what you can expect in fourth quarter from us, how we can assist you going forward. One other note, Lance Miller, our wealth manager, is handling the Q&A. So if you go down to the bottom of your screen, you should see a little Q&A icon. And feel free during this presentation to ask any questions that you have. If it's going to be specific to the topic that I'm covering, Lance will get to that first. If it's not specific, it might be a little more general. That's okay. We will look to get to those next. At the end of my presentation, we will have a general Q&A. We'll hang around a little bit for that as long as those keep coming in. And we will make sure everybody gets a copy of this tax guide towards the end. So with that said, you should see on your screen the new tax laws you can leverage now. So what this does for us is streamline. There is a lot in this tax law across the board that was passed in July. So what we're trying to do is streamline this to the most specific areas for our clients. And the key takeaway today is how things interact. And I'll explain that in the second half. And that's really what we believe is the most important. So in fact, we have actually got a new tax software program that we're utilizing for clients that have all these tax codes updated. It is a tax specific program. It is really allowing us to help clients navigate some of these different boundaries as far as income versus the benefits. And there is some trade-offs, which I'll explain again today as well. So with that said, let's dig into this tax guide. And we're going to start with the SALT deduction. And I'm going to highlight and blow up an area of this SALT guide. And many of you may not know the acronym. So this is state and local tax deduction. And it might not have been on your radar, quite frankly, because it's been capped at 10,000 and it's been left there for some time. This obviously, we're a Georgia-based firm, so we kind of joke, we put ourselves in the higher tax states as New York and California. But in reality, this really does open up some additional tax deductions for clients across the board. The key to this, now this is higher income, but you do phase out. So you lose this starting at 500,000. You adjusted gross income. You potentially also lose this as an individual filer or married filing individually at 250,000 or higher. But the significance of this would be best served by giving you an explanation specific to an example. And that example is on the top right-hand side here. Let's say we were paying 15,000 in property taxes and our state income tax bill in a paying state income tax of Georgia was $8,000, for example. So 15,000 plus 8,000, quick math there is 23,000. Under the old rules, you were capped at a $10,000 deduction. Today, if you are under those income limits that I stated, you do not have that cap. Your cap is 40. but a combination of 15,000 plus 8,000 gives you 23,000. Now you have an additional 13,000 above your previous 10,000 cap that you can leverage. For an average tax bill, that could be hard tax savings in the $3,000 range. So this is significant. And the good news is the income limits are fairly accommodating at that high level of 500,000 for joint, 250,000 for individuals. I'm going to move on to the next area that we feel is very important, and that is going to be an additional standard deduction amount for 6,000. So a couple criteria here that you have to keep in mind. First and foremost, it is for folks age 65 in the year that you turn 65 or greater. It is a $6,000 deduction, but there is one key, and that key I'm going to highlight here is you have a much lower adjusted gross income hurdle. In fact, it's a cap, would be considered a cap. It's 150,000 for joint filers, and it is only 75,000 for individuals. So that additional $6,000, you have to be under those limits. So things like Roth conversions, capital gains, there's a lot of things that could get many people, even in retirement with lower overall income or adjusted gross income, over that limit to not make this additional $6,000 deduction. One additional area that I think would be important to focus on is how this compounds. So in the top right-hand side here, if you can see my cursor, if you are 65 and you're single and you are below that $75,000 income limit, your standard deduction is $23,750. Pretty substantial, typically compared to most folks that are going to itemize. You are usually going to do better with the standard deduction versus the itemization. Married filing jointly gets even better. Now, let's just consider if one individual qualifies for the 6,000, that gets you up to just shy of 40,000 in a standard deduction. That is significant. Again, the max you can get if both spouses qualify for the 6,000, you are at 46.7. Again, we haven't seen these levels before. This is a new high on a standard deduction. Doesn't mean it still does not make sense for some folks to itemize, but you have to take a hard look at this first. You can save a lot of tax dollars with your CPA not going through the motions of itemizing, and we can help you guys with this versus knowing, hey, I'm at 46.7. And the likelihood of me giving all my bills and itemized tax info to my accountant, having them run all that just to come back and say, yeah, you're better off with the standard deduction, is certainly what we want to try to avoid. So that's probably the biggest takeaway here. So let's move on to retirement account maximization. Now, we're getting into laws that haven't necessarily changed dynamically, but with cost of living adjustments, we do want to make you aware. So we're going to shift gears a bit. This specific information is more for folks that are currently in the workforce. For you retirees out there, this is certainly information to pass along to kids, even grandkids, anybody that's in the workforce that can benefit from this. And I'm going to highlight one area here on the guide, and that is these updated limits. So if you are under 50, this is age-based. So if you're under 50, you can get up to $23,500 in a 401k, 403b, 457 plan. And that is your individual contribution amount. That is not a matching contribution. We're just sticking to what you can contribute as an employee or as an individual contribution. When you get to age 50 or greater, you do get a $7,500 catch up. That is substantial. That gets you to $31,000 for this year. And then this is a positive, but this is where it gets a little complicated. There is an age bracket from 60 to 63, including age 63, so technically 4 years, where you have a special catch up The bottom line math on this is it adds about $37.50. There's a different calculation we can help you with. But bottom line is, if you are in that sweet spot of age 60 to 63, you can get up to $34,750 deferred in a 401k or those typically educational or governmental plans, 403B or 457. For those small business owners out there, folks that own an LLC, this applies to solo 401ks as well. And we are just talking about the employee portion, not the employer contribution. So significant increases here. And we would encourage clients to not look at the percentage. And we can help you with this on a screen share. But as you go into your 401k, always try to identify syncing up the end dollar amount, obviously, on this to get you where you need to be. And the reason I mention that is we'll have conversations with clients in the fourth quarter, and they did a certain percentage, assuming that the system was going to max them out, and it's not quite getting them there. And then they have to face the harder decision of, okay, do I make a substantial increase in contributions now, maybe sacrificing income, sacrificing budget towards the end of the year to make those limits? Whereas if you set it properly on the front end of the year, it's a much smoother ride. So going into first quarter of next year, again, that's something we can offer by way of a quick screen share to make sure that you're maximizing these benefits. I'll wrap up on this page talking about the traditional and Roth IRAs. Under age 50, pretty straightforward. You're at a $7,000 max contribution. And age 50 plus, that does bump up to $8,000. Check in with us on the income limits there to determine if you can actually make a Roth contribution. There are certain scenarios by way of Roth contributions, backdoor Roth contributions specifically that we can consider if the situation fits. And then in addition to that, on the traditional RIA side, IRA side, I have RIA on my mind. The technical aspect there is you might not be able to deduct that. And we want to determine that if you're doing this in addition to a 401k plan, might not make sense, might be best served in a different area. We're going to cover HSAs next. That's a great area to consider if you're not getting that tax deductibility. So I know we've got some questions coming in, and hopefully those are getting answered. I'm going to move on to the next topic now. And that's going to be estate. So really what I want to focus on this page specifically is just the limits. So I'm going to be real brief on the lifetime exemption limits. That's going to run into our estate discussions with clients, and we're happy to have those on a one-off basis. But really what I want to get across on this page is your annual gift exclusion is now $19,000. What does that mean? That just simply means you are able to give to any individual up to $19,000 without having to file a separate gift tax return. If you're giving away $20,000, technically by IRS guidelines, you've got to file a gift tax return. Doesn't mean you have to pay to make that gift. It just means the IRS wants to make an accounting of that gift. If you are at $19,000 or lower, you do not have to worry about any tax reporting on that. And you can give a $19,000 gift to a daughter, a son, a grandchild. So you can, depending on your situation, you're not limited to an aggregate of $19,000. You are limited to a total of $19,000 per individual. And the number of gifts you could give technically is unlimited. So I'm going to move on from this. And we are going to get close to the end of the guide here. I'm going to go briefly over the business owner benefits, and then we're going to spend probably the bulk of the rest of the time here on HSAs. For business owners, we tend to focus on 1040s. So 1120s, we don't have the tax reporting software, so we're not able to model specifics within the business world. We're going to typically tend to lean on our CPA. Most of our small business clients have a CPA relationship that we can lean on here. But it is interesting from the standpoint that you have some, really a continuation of the Section 179. I think that's probably the focus. Equipment is 2.5 million. You're phasing out in the $4 million range. And you have accelerated depreciation on top of the Section 179 5-year window. And that is significant, where you can essentially get just about all of it a write-off that you plan to have on equipment in 1 calendar year is what that essentially means. I do want to mention some takeaways on the small business side. If you have not opened a solo 401k, if you're a smaller outfit, or you do a lot of contracting, solo 401ks can be great. And SEPs, discuss that with us, please. Equipment purchases by year end, that goes back to the Section 179. Quarterly estimated payments, we can assist with that. Optimizing salary distribution mix and S corps, we can certainly give you some consulting there as well. And then business entity structure, nothing significantly has changed with these new tax laws, but it's always something to keep top of mind as it relates to potentially saving on Georgia tax with some of those benefits there. So let's shift gears. Let's talk a little bit about HSAs, and then we'll be done with the guide, and we're going to spend the rest of the time, about the last 10 minutes, focusing on how we're able to put this together for you guys and show you some of the benefits of that in real time. So HSAs, health savings accounts, the limits have gone up, which is great. I'm going to highlight those. This is going to be here. If you can see my cursor, if you are an individual, you can get up to $4,300 in an HSA now. Family, you can get up to $8,550. And there is a catch up at age 55 plus to get you up to $9,550 in an HSA per year. There is a cost of living adjustment right now. It looks like it's going to be in the $100 to $200 range for 2026. Now, let me take a quick step back and give you our analysis on why HSAs are so important, why we get really excited when we talk about HSAs with clients. And that's primarily because of the triple tax savings benefits. First of all, you get a tax deduction. You have to be in a qualified health savings plan to make an HSA contribution, first and foremost. So certainly check in with us in that regard if you have any questions around that. They're usually high deductible plans, but an HSA contribution is tax deductible. So big benefit that comes right off your taxes in hard dollars. Comes right off your income, essentially. And for most folks, that is a significant benefit. The second benefit is tax deferred growth. HSAs have essentially turned into 401k plans for all things healthcare. And you have investment options. We can link that to your planning website. We can assist you with the investment options for these HSAs. And then the third tax benefit is for anything essentially health care related, including premiums for Medicare. You can pull the money out of that HSA tax-free. So we want to try to get as much growth on that HSA as possible. And ideally in retirement, we can pull money back out of those HSAs and not pay tax. This is the sole investment vehicle that offers that triple tax benefit. Even Roth IRAs give you 2 out of 3. The HSA gives you 3 out of 3, which is substantial. We love to look at HSAs as a potential funding source for long-term care policies. And the reason for that is there have been in the past issues with long-term care policies adjusting premiums and or reducing benefits. They have improved. Part of our financial planning process is to assist clients with determining that does a long-term care policy fit. As most of our clients know, and for those of you that might not be clients on this call, we are fiduciary folks. We don't have an insurance license. We don't sell long-term care policies, but we model them. We provision for them in your plan. We give you specific suggestions on how much coverage you might need. But one of the most cost-effective ways to self-fund that long-term care, instead of giving premium dollars to an insurance company is giving it back to yourself by way of a tax deferred vehicle with an HSA. We can calculate how much money you might be able to get in an HSA, or based on how much you have as part of your budgeting, turn off that HSA distribution. Don't spend it on anything, hoard that money. Keep that money longer term and use it as a potential bridge for the first, typically for the first spouse, to have funds for that surviving spouse to use and not deplete your net worth in an unfortunate situation where healthcare costs are significant towards end of life. So I'm going to go zoom back out here, and that's going to conclude the tax planning portion of this. So we are pretty much spot on, about 10 minutes left. I'm going to shift gears. We're going to get into our tax software. I'm going to show you how we use this for clients and what we want to be aware of from now to year end as far as modeling. Okay, hopefully everybody can still see the screen. So we're shifting gears here to the tax planning overview, and what you see on the right is some of the software outputs from our program. We're going to cover marginal tax brackets. We're going to cover how this actually ties into Medicare Part B premiums. That is means tested. We've got to be careful of certain things as we're considering tax benefits towards the end of the year here. So let's start with marginal tax bracket breakdown. So ideally, what we do for clients is we will get a copy of your most recent tax return. So for most folks, today's October 15th. So for you folks that are extended filers, you would have a tax return very shortly. For other folks, that was obviously done by April 15th. We get a copy of your tax return, and then we do the rest. What you see here is a rendition of what somebody's 2024 taxes might look like. And on the right-hand side here, you're going to see the ordinary income, and you're going to see the tax brackets. So we start out our tax planning and our investment planning by determining how much more income can we realize. Now, that might be by way of capital gains realization. Do we sell something that's appreciated? Are you selling a piece of rental property, real estate? We've got to take all those things into consideration ahead of year end. Additionally, going back to Roth contributions, and more specifically, Roth transfers. So are we making a Roth conversion? Are we moving money from a qualified pre-tax retirement account into a post-tax Roth account that is taxable income that is realized? And what we do for clients is determine how close we can get to that next tax bracket to not get you into paying at 12% and paying more at 10%. Now, in reality, the big jump is from 12% to 22%. We are showing you a joint tax table. So at 96,000, that's when we get into that 22%. And we've got we really don't worry as much 22 to 24. We don't worry as much 10 to 12, but that 12 to 22 is a pretty big jump. So moving on from that, we like to look secondly at your capital gains. It is a separate calculation. As you can see here, it is much more forgiving. So we don't pay any capital gains tax up to that 96.7 amount. Over 96.7, we're in the 15% capital gains bracket as long as it's long term. And then once we get north of 600,000, now you would primarily assume that's a high income earner. However, what we see very commonly today is people selling their house. And if it's a rental house, you don't have that 500,000 exclusion, 250 for individuals. And with price appreciation across real estate over the last decade, we have been seeing some one-off scenarios with clients in retirement that generally have lower income, realizing higher income. And we're going to show you how that impacts not only on the capital gains side, but also with Medicare as well. So this is the second calculation that we do, and this is very important because a lot of folks are obviously tax paying averse in general, and they associate that with capital gains. Hey, do we sell this and do we realize a gain for diversification, for cash flow? A lot of people oftentimes won't even mention that to us as far as thinking about it. We're going to be proactive with that because you could be paying in the zero bracket. We could be able to get you in a scenario where you're paying very little in the 15% bracket for that. Let's move on and let's talk a little bit about how we look at the big picture here. So this is modified adjusted gross income, planning considerations. And what this does, once we get through that first tax portion of what I just showed you, primarily tax bracket, how much to get you to the next tax bracket, and then specifically how capital gains may look, what brackets you may be in, specific to capital gains, long-term capital gains, we're going to focus on all the potential deductions you may get, you may be qualified for. Specifically, we're going to go back and we're going to look at the enhanced deduction for seniors. That was the $6,000 additional standard deduction that I mentioned towards the beginning of this call. And again, that phase out is 150 to 250,000, starts at 150. And then also the SALT deduction. So again, if you got a real big realized capital gain with real estate, that starts at 500,000, and it essentially over 600 reverts back to that $10,000 minimum instead of the 40,000 maximum that we have today. So that is one phase of the report that is extremely beneficial because you're just having to keep up with so many changes in the first year of a tax code change that is this dramatic. And then the second part of what we like to cover as we wrap up this tax analysis is going to be Medicare. So keep in mind there is a 2-year delay. And when you, so for example, in 2024, let's say we are at $250,000 of income. We're not going to see our increase in our Part B premium until 2026. There is a 2-year delay. So this tends to be out of sight, out of mind for clients. We'll go ahead and, we'll sell a piece of real estate. We'll realize capital gains. We'll do a big Roth conversion. And we want to go back to that standard deduction benefit at 150,000 phase out. We want to go back to the SALT 500K for joint. And then the third area we want to check in is this Medicare premium. And as you can see, everybody's getting these same Medicare benefits. It's just if your income in one given year is higher, 2 years later, you will pay potentially significantly more for the exact same benefit as somebody that might be in a lower modified adjusted gross income threshold. So that's what we really want to get across is there are so many pieces to the puzzle as far as income, some benefits to say a Roth conversion, increasing your income up to a certain tax bracket, but then we've got to see what collateral damage might be happening down the road 2 years from now with Medicare costs, and we want to provision for that. We want to run an analysis to see, hey, we're getting a tax benefit here in this calendar year. What is that doing to us in the future, and how does that look? So to wrap up on the scenario planning tool, and I know I'm wrapping up right at 12:30 here, and we're going to see if there's any other questions that we can answer. But this is really the key. This is probably the most important thing that we do for folks, and that is the scenario planning tool. So as I mentioned to you before, we're going to take 2024 tax year. We're going to analyze it. We're going to plug it into our system. All we need is a PDF of your tax return. It plugs automatically into this software, which is great. Then we're going to do a mapping over to 2025 tax code. So we're going to make assumptions. If we know your income is going up or going down, we're going to make assumptions and adjustments to make sure that we're as accurate as possible for what 2025 is shaping up to be. From there, we're getting into scenario mode. If you look in the middle of your screen at the top here for this heading, tax year 2025, switch to Roth conversion. Now we're stress testing your tax plan to see how much of a Roth conversion you may be able to weather to keep you in a lower tax bracket. How does that affect the benefits such as that new 6K standard deduction? How does that affect your SALT deduction if you qualify for that? Are we itemizing? Are we standard? This software is great. It can also give us a pro rata on estimated payments as well, which is neat. And it also, as I mentioned previously, will give us a 2-year forward look at your Medicare surtax costs. We factor all that in together. And then in this particular plan, we came up with a scenario for these clients of, hey, does it make sense? We've run the math on, hey, is it more beneficial or less beneficial to take Social Security now or to push it out? For these particular clients, we wanted to stress test delaying Social Security to 2027, maximizing Roth contributions in 2025 and 26. And that ended up making the most sense for these particular folks. The fourth scenario we ran was delaying Social Security to for them, age 70, and delaying Roth conversions to see how that would play out over, say, a decade on an aggregated tax basis, meaning how much complete tax would you anticipate to pay given those different scenarios to see how things play out in one calendar tax year versus a longer period of time. So hopefully this gives you an understanding, a flavor of what we're able to do in this tax year. This is the first year in some time we've had such sweeping tax changes, and everything is retro to January 1 of 2025. So all this stuff is live and in effect. We've got to make some decisions at year end, and we are happy to assist you in any way we can in those regards. So really the main purpose today was to get you acclimated with these tax law changes, the most important ones, and show you how we're assisting other clients in navigating not only 2025 tax year, but moving forward as well. So with that said, I want to thank everybody for tuning in today. Any questions that you have that we can answer now, please let us know. And I'm going to check in on the Q&A now, and we will be wrapping up here shortly. And bear with us just a minute. There might be some Q&A that I can answer live. I'm going to give just a second for that. So we do have one question. I'll answer this one live, and that is, do we ever think that Medicare restrictions regarding HSA will be lifted? And my personal thoughts there is no, unfortunately. I think that goes back to the deficit discussions and things that are going on just with the budgeting, right now with the government overall. And I think there's going to be some really hard decisions that are going to be forced, finally to be made on the political side with Social Security. And I think Medicare is in that same camp. It's been the untouchable category. I do think it will remain untouchable for folks in the system, folks that are aged in, whether that's 65 for Medicare or 62 for Social Security. But I do think there will be substantial changes coming for folks that are in the workforce by way of having a larger amount of their income taxed, and also just changes by way of age, pushing things out, pretty significantly. But the bottom line is, unfortunately, I don't think they're going to give a tax benefit by way of allowing you to contribute to an HSA, while you're in Medicare, because again, it's a giveaway. It's a tax benefit. I think those are largely behind us at this point until we have some pretty significant changes with Medicare, Social Security, all those entitlement programs across the board that are accounting for over 2/3 of the budget, currently. So thank you for that question. I'm going to hold just for a minute and see if there's any more. Looks like we have no additional open questions. I want to thank everybody for taking the time to make it today. Again, we're going to try to put these webinars together on a more frequent basis. We will still have our in-person events, and we love those, but we find the webinars can be a little more a little more time effective for everybody, and can certainly help in that regard, and hopefully get people kind of what they want to understand about a particular topic. And we try to be as timely as we can with these topics based on fourth quarter, we feel being optimal for tax. So with that said, I want to thank everybody for connecting with us today. And feel free to reach out. Those clients out there, feel free to reach out with any questions by way of email. I want to just verbally quickly give my email to anybody that's not a client that would want to reach out to me directly, and that's robert.amato, A-M-A-T-O, at Compass, W-M-C-O-M-P-A-S-S, W as in wealth, M as in management.net. And thank you so much.